I don't know how many sips I will have to drink out of that cup before I will actually film an intro for this video. It's not because I'm super thirsty, it's just because I'm so excited to be finally back on my YouTube channel on 2022, and I hope you all the best for this year. So in today's video, I would like to discuss a strategy that was requested long time ago and I finally able to make it, and that's including a whole moving averages. The majority of Forex and stock traders, they are using different forms of moving averages, and that's absolutely brilliant. However, the main factor with any indicator that is based on moving averages is the lagging aspect. For example, long story short, when it comes to trading, I always like to use my 25 and 50 moving averages. However, when I found out about the whole moving average strategy, my mind was like, I need to share this with my followers, my subscribers, because it's just insane. It's like a beast when it comes to trading. So buckle in, guys, and let's get started. So one of the most frequently asked questions when people see the whole moving average is how does it differ from a normal moving average? That's a great question to start with, and let me show you an excellent example so you can see the difference yourself. Here is a chart with the 3 different moving averages I added on. A 50 period simple moving average, that's in pink color, a 50 period EMA, that's in dark blue, and we have a 50 period whole moving average in orange. The first thing you will notice about the whole moving average is that it has a tendency to follow prices considerably more closely than both the simple moving average and the exponential moving average. And when I was backtesting this strategy on all the currency pairs, I can definitely spot something that you might find it helpful. So during a market shift from a non-trending to a trending one, you can see that the 3 moving averages are staying relatively close together over here. I will add an example so you can see yourself. But for example, here, when the market shifts into a trending one, so it's either to the upside or to the downside, you can see that the whole moving average is very quick to follow the price and it remains relatively close to the candles. However, the other 2 moving averages, so that's MA and EMA, they lag behind the price by a large amount until the market stops trending, and the 3 moving averages are once again, they are near to each other. So therefore, this explains why the whole moving average is totally different from other moving averages. And in general, the major goal for the whole moving averages is to eliminate that lag that is associated with the normal moving averages while still ensuring the smoothness of the indicator. Before jumping into the whole moving average strategy, let me guide you on how you can add this indicator to your chart. So step 1, of course, is to go on the tradingview.com, and on the left hand side you will find an indicator section. All you have to do is press on it and type HMA, which is whole moving average, and basically double click on it. Now, because you have them on the chart, they come up with the default settings, but for this strategy we will have to adjust them. So simply choose one of the moving averages and change from default to 50, and the second one will be 25, and basically click OK. So for the sake of explanation, I have included a basic moving average with a period of 50. So let's take a brief look at this chart. We have a clear uptrend, we have a whole moving average in orange, and we have a simple moving average in blue. Now consider the point at which these moving averages begin to trend upward and follow their bullish momentum. The simple moving average was sloping downward until this zone when it began to trend upward. So let's compare this move to the whole moving average. Well, the whole moving average also sloped downward, but it had rapidly started to trend upward, and as a result the whole moving average produced less lag when compared to a simple moving average, simply because it includes the weighted moving average in its formula to help it out. So the main question is how you can use whole moving averages in your trading. Well, the first thing you should know about this indicator, especially if you're looking to employ numerous of the whole moving averages on your chart, is that it was not created to be used as a crossover signal. You may be surprised to learn that in every other trading video that have been using moving averages, that crossover is like a heart, like a base of the strategy. Am I right? But however, you will find out later on why the whole moving average strategy that I've been using today is not to be used as a crossover signal. Of course, in a trending market, the simple use of a moving average would be an effective way to employ, because once the crossover is produced, you may buy or sell depending on the market conditions. So let's say if we replaced moving averages with whole moving averages, you would notice that there is an enormous number of crossovers that happened, and if you traded all of these crosses, you will have lost much more money. That is why I keep advising the people who are watching my videos that it's so important to get that knowledge about the strategy, about the actual tools you're planning to use, because it will make a major difference, because you will be able to use them in your advantage. And to get back to basics, the whole moving average is used to determine the direction of an overall trend in the market, and also it's been used for an entry and exit points, but not for a crossovers. So to give an idea of how we use the whole moving average, take a look over here. When the whole moving average is trending up, we would of course use that as a confirmation to look for buy opportunities only. On the other hand, if the whole moving average is sloping towards the downside, we will look out for sell trades only. And once you have identified a strong trend with the help of the whole moving average, we can use it as an entry signal as well. So when you're using this indicator, I recommend using a lower settings to make that more visible. So what I mean by this, when I mentioned you can use numerous of the whole moving averages, the one can be for the trend and another one can be for an entry and exit signals. And just like with the EMA or SMA, you can increase the length of the whole moving average. This changes how far back the indicator looks into the price history when analyzing market conditions. So here's a little sneak peek at the trade I performed using this strategy. I have GBP NZD on the 30-minute time frame. Of course, if you're looking to employ whole moving averages in your trading, you'll have to begin by analyzing higher time frame analysis. You'll have to search for support, resistance, trend lines, and any chart patterns that will help you along with the strategy. So what I was actually waiting for is for a nice bounce of the moving averages to support my setup, which of course has occurred on the 30-minute time frame, because as you can see, we had a nice bullish engulfing candle bouncing off the whole moving average, and 1 hour time frame had a nice confirmation as well. That was a bullish engulfing candle bouncing off a trend line, which is also a great sign to support my setup. So as you can see by now on the right side of your screen, these are the profits based on the strategy for the GBP NZD trade. And my overall opinion is that this strategy has a very high expectations and profits if it is applied correctly in order to succeed. So that was it for today. I hope you enjoyed my first video of 2022, and if you found this video helpful, you can leave a like, you can comment down below how I did, or what would you like to see next, and I will make sure to take care of it. So once again, thank you guys for watching me, and I'm so excited to see you next time. Bye!